Hello and welcome to another Securities Lending Saturday. I'm Roy Zimmerhansl. I'm your host. And today we're not going to be talking about securities lending. Today we're going to be talking about repos, also known as sale and repurchase agreements. But it's a key and bigger part of the financing markets than securities lending. So that's what we're going to be talking about. So if you are part of the securities finance or investor community, if you borrow, lend, invest, or leverage, then this is the place for you. So let's get started. Hi, everyone. I hope everyone's having a great Saturday. It's a sunny day, and I always feel better on a sunny day. This is the spot for the YouTube channel. You can find it there. We have, I don't know, over 100 videos or on that, 45-ish in the last sort of 12 months. We've been running not quite one a week, but pretty darn close. Remember, you can also get copies of the slide deck. So if you want to get copies from all of this video, all the videos that we've actually done, you are more than welcome to sign up here. And then over the course of the next few days, we will send it out to you. I am trying. So I have now got three. In fact, I've got 5 screens around me. And fortunately, one of them is showing me that you're actually on and I can actually see your name, but I can't see it on my board. So good morning to you. Thanks very much for joining from the US and the East Coast, where it's still very early. So I'm really thankful that you're watching so early on a Saturday. Okay, why don't we get right into it? So let's get started. As I always have a slide deck with me, and why would this week be any different? So today we're talking about repos. They're also known as sale and repurchase agreements. I'll explain that when we get into the terminology. But repos is the most common one. Although I got to tell you, the number of people that actually sign up for my LinkedIn group, where I run a group called the Securities Lending and Repo Network, there's quite a lot of people that are repo people, like car repo people, that join the group and then realize they're in the wrong place. So that's always quite funny. Nilesh, great to see you again. Thanks for coming back. Appreciate you being here. And let's get into this session. This is what we've been talking about. Originally, I was going to this week do something about a comparison between securities lending and repo. Then I realized that really doesn't make a lot of sense unless everyone's on the same page on repo. So what we're trying to do is, in this one, we will level the playing field so people understand a little bit about it. Next week, then we'll also talk about some more detail of it, so you can look at the transactional level information on it. And then the third part of it will be the actual comparison. 3 sessions on repo. One, this is a very high level overview. Next week, we're going to get into some more detail. And then week 3, we'll do a comparison between securities lending and repo. Similar economically, but practically there are nuances and differences. So we will get to that over the course of the next few weeks. Let me say hello also to Harbin. Thanks for joining. And Kartik. Thank you very much, guys, for being here with me. And we will now look at the 4 questions that we will be answering today. Repos. What are they? Or what is repo? Why do people do it? I'll show you some statistics from both the US and Europe. Some interesting information, which just puts everything into context. And then we'll close off today with who does it. And I think the image here is, I was quite happy to find this one, because really repo fundamentally is about one party that has cash and one party has an asset, in this case, a paper bag, but typically securities of some type. And it's really about the exchange, and each party has their own motivations for doing that. We'll look at some of those motivations today. If you find this video helpful or the series helpful, I really appreciate it if you give me a thumbs up or a like or whatever it is on whichever platform you're watching. Even if you're not watching it live, this helps me understand which videos you want to see more of. The video that I did about 18 months ago, which did a specific comparison of securities lending and repo, is one of the most popular ones I've done. So that's really what prompted me to do this session or these coming sessions over the next few weeks. And again, if you like the content, give us a thumbs up. Okay, let's start with the beginning. What is a repo? First of all, it's a short term transaction, and it's between a repo seller, so someone that actually has securities that they're willing to deliver out or they're interested in borrowing money against. So they're the seller, right? They're selling their asset into the market and getting cash in. And then there's the repo buyer, the entity that's actually, as it says, buying the securities from the other party. So they're delivering cash and they're receiving securities. So it's short term. It's a trade between a seller of securities and a buyer of securities. So obviously cash exchanges. And although typically people think of it as a cash loan or a cash borrow, depending on your side, in reality, it's actually the repo seller making a sale, an outright sale, and agreeing at the same time to repurchase it. So leg one is a sale, leg two is a repurchase, and there's full title transfer. So the cash receiver can do whatever they need to do with the cash. The security receiver also has the ability to do whatever they like with the securities that they own. Okay, so it sounds like it's a cash loan, but really it's a couple of outright transactions. Now, because it's documented within one single agreement, it does provide benefits in terms of netting. So if your counterparty goes out of business, you can offset the two positions, the cash and the securities. Now, often people ask which securities are involved in this. And the truth is, it's really any security that's acceptable to the cash lender, right? Because the cash lender is the one, in theory, that's taking the risk. They're buying an asset and they hope to get their money back in future. And if the counterparty goes out of business, all they have left is the asset. And so they have to ensure that the asset has enough value to recoup the money that they've loaned out plus any interest or opportunity cost otherwise. So the reality is it really runs the whole gamut from the most high quality instruments, so let's say US treasuries or bunds, through to very illiquid securities. In fact, a fair part of my time is working with the clients where what I help them do is finance illiquid assets. And so it can really be anything. It's about what the cash lender is willing to accept. But usually it is indeed a high quality asset. And it's also, as I said at the start, it's a short-term transaction. In fact, the majority of trades are actually overnight repos, just overnight transactions. Needs money or has money, and they're just trying to do something with it overnight to generate a better return if you're a cash holder than you might in a bank or alternative investment for just holding money overnight. So while overnight repo is the majority of transactions, almost all, the overwhelming majority of transactions are less than a year. But of course, there are multiple year transactions as well. And again, that's something that I do with one of my clients. It's often they are multi-year transactions. So it's really whatever the two parties can agree. That's the important thing to remember. It's whatever you and the other side are willing to do. And in order to come up with a price, you need to know who your counterparty is. You need to know what the quality of the asset is. You need to know what the tenor of the transaction is, and you want to know what the maintenance is, right? So what's the margin requirement? How often does the updating and revaluation of the margin and variation margin move? All of those, and what happens in the event of an asset falling below a credit criteria? What happens then? So all of those factors, you put it into it and put it into the spaghetti machine, and out at the end, you get a price. So it's whatever parties agree. Virginia, I certainly hope I'll get to 500 this week. Thanks for saying that. I'm sure all of you are tired of seeing me or hearing me talk about getting to 500, but we will get to 500. Usually, in fact, usually it comes in the next couple of days. I think, yeah, hopefully by Monday is what I would expect, but let's see. Okay, so that's what a repo is. Short term between a cash lender and a cash borrower, usually with high quality assets and almost always with a tenor of less than a year. I want to talk about some of the common terms that you will hear or come across. And if there's anything else that you want to know the answer to, just pop it into the comments and I'll answer it this week or maybe next week. But the first thing that I often hear is, okay, I get repos, but what's a reverse repo? And I can bore you with stories on that. But look, the bottom line is a repo and a reverse repo are the two sides of the transaction, right? So there's a cash lender, cash borrower, or a securities deliverer and a securities receiver, or a repo seller and a repo buyer. And for one of those parties, it's a reverse repo. And for the other entity, it's a repo. Okay. So it depends on your perspective. They are the same thing. So the repo seller, the one that's doing a repo, is the one that's actually delivering out their securities and getting in cash. And if you think of it, the reason the name is sale and repurchase, the repo is a sale of an asset and then a future repurchase of that same asset. So a repo seller is doing a repo because they are selling and repurchasing the asset. Okay. The repo buyer is what we call reversing in the bonds. So if you always think about that, if you ever get confused, just think about a reverse repo. They're reversing in bonds. Just say those words, reversing in bonds. You'll always know which way is going, because if they're reversing in the bonds, that must mean they're delivering out the cash. An easy way to remember it. Now, the repo rate is the interest rate that's charged. So, it's usually quoted on an annual basis. So it'll be whatever, 25 basis points. That's 25 basis points for a year. So if it's a 1 week repo, that would be 1 week worth of 25 basis points. Okay. And sometimes you hear people talk about central bank repo rates. That's a rate that the central bank will lend money to their community that's allowed to borrow from them, usually primary dealers and mainstream banks, but not always. So that's that. Sometimes it's a central bank repo rate, and sometimes it's just the repo rate between the two parties doing a transaction, or there are also benchmark rates where people talk about what the repo rate is. So it's always relative to whatever the context is of you're talking about. You're talking about what the central bank does, you're talking about a benchmark, or you're just talking about the rate for your transaction. Now, the phrase general collateral is used in securities lending and repo, but it started in repo. And to me, it's much more accurately used in repo. So, general collateral, when we talk about it, as we say, it's collateral. So, first of all, it's whatever the cash is being loaned against, and it's general. So, what it really means is I'm willing to take, if I'm the cash lender, I'm willing to take any assets within this category, anything that looks like this, anything that has the following characteristics. And what I mean by characteristics might be, it could be a government issuer with a AAA rating, or I might say, I will take any government bonds issued directly by the US government and anything that's fully explicitly backed. But I might also take German government bonds, again, with the same criteria. And if you are going to give me collateral today of US treasuries, but you need it back tomorrow for another reason, I'll take any other US treasuries, or I'll take the German government bonds as well, because I think they're all, from a risk point of view, for the term of my transaction, I think that they are interchangeable. So I'm okay with one or the other. And if you need to change, it's really any of the issues that meet that criteria. I have a general criteria, and any asset that falls within that, feel free to deliver that to me as good, acceptable collateral. So they can be used interchangeably. Then we hear words about bilateral and tri-party collateral. So bilateral collateral would be where you and I agree directly what the terms and conditions are of our transaction. If I'm delivering you bonds or whatever the collateral is, I'll deliver it directly to your account wherever you want me to deliver that. So that's just between the two of us. Tri-party, and we've talked about tri-party collateral with respect to securities lending in a previous video, which I'll put a link into. Tri-party really involves a third party that acts as the custodian and administrator, really facilitating the transaction. So you and I, again, agree to whatever the cash lending terms are and the tenor and all of that. And then we'll have schedules set up at the tri-party provider that says when we do a transaction between each other, it will follow this schedule. And then the tri-party provider makes certain that the correct securities of the correct qualification and characteristics are in the right location on the right days. Okay, so one is more operationally intense directly between us. So there's more work for us to do with each other, but there's fewer costs because we're not engaging a third party, the tri-party agent, who charge, of course, for their services. They charge, obviously, an administration fee. So it's a little bit cheaper, but it's far more flexible. And so you see use of both of these activities on a daily basis. Both of them are very large. Then you might also hear about buy sellbacks. And a buy sellback is similar to a repo trade. And it's similar because, on the one hand, you have, let's say, from the cash lender's point of view, the cash lender is buying a bond, for instance, and they're selling it back in future. But it's not done as a repo transaction. So it may be documented. So there are annexes that attach to repo agreements that says some trades that are specifically identified are not repo trades, they're buy sellbacks. So it can be documented or it might not be documented. But there's a few differences why it's not exactly like a repo. Number one, it doesn't provide for variation margin. So whatever you and I agree the value of the transaction is, I'm going to lend you $1 million and you're going to give me $1,080,000 worth of collateral. Okay, so that's it. I've decided I want an 8% margin and I'm lending my cash to you against that. Now, if the value of the assets I'm holding falls by 1, 2, 3, 4, however many percent, unlucky for me. So I might do a higher margin, or I might be willing to take the risk because I'm not worried about you going out of business. But it's static, and that can actually have an impact in terms of capital reserves. So that's one of the challenges for buy sellback. So on the opening leg, I'm buying it, and then that's my asset, and I have to hope that asset holds its value until the end of the transaction. At the end of the transaction, we do the exchange, and hopefully everything is fine. Now, the other thing that happens at the end of the transaction is that in a normal repo trade, if I take a bond from you as collateral and that bond pays a coupon or pays interest during the time I'm holding onto it, then I'll immediately give that to you. Or in some cases, in fact, the intermediaries can automatically pay it to you. But in any case, if you were the original holder of the bond and you sold it to me in a repo transaction, so you did a repo, took in cash, and I now get the coupon, which you should have got, it gets back to you on the same day, right? So you get your money. There's no impact on the cash flow. Whereas on a buy sell back, you get it at the end. So it's calculated into the end transaction. On the sell back, so when I'm selling it back to you, we take into account the interest that has been earned, and we take into account any coupons that may have happened during the transaction. And that also adjusts the end price. Now, the biggest issue and the biggest risk is that in the event of a counterparty default, buy sellbacks are really just can be looked at as two separate transactions with no relationship and no bearing on each other. And whereas in a repo transaction, you would look at the value of the cash that was loaned and the value of the securities that were taken as collateral at the time of the event, so the default event, and you would net them off. In a buy sell back, there's no guarantee that will happen. It might just be one directional and the other direction, and that can have an impact, in material impact in terms of outcome. So buy sell backs used to be a lot more common when I first got involved in the business because firms weren't used to operating under repo transactions. They didn't really like documentation, or it was easier to do it without documentation. Then all of a sudden buy sellbacks started getting documented as well, and that was generally a good thing. But there are still many markets that operate, particularly emerging markets, that operate on an undocumented basis, or might be documented but more commonly they would do a buy sell back as opposed to repo. And it's just about what the market convention for that area is. So you might hear about buy sell backs. Okay. Kartik, question. Can you quote an example for repo trade? I will do, but I'm going to do that next week where we get into more of the details, and I'll work through just some examples of simple repo transactions. So hope that's okay. Hope you can wait another week and we'll go through it then. Okay. Just bear with me for a second. My throat is giving out again. Still not sponsored by Coke, but I live in hope. Although I have to tell you, Diet Coke is definitely a poor second cousin to Coke Zero, but I haven't had any in my store. I don't know what's going on. So fix that, Coke. Why do repos and reverse repos? Well, like, there's multiple different responses to that, right? There are many different reasons. I've listed out most of the common ones here. And the reality is that the scope and the breadth for repo usage has narrowed after the global financial crisis until fairly recently, because until we had different interests, the trading aspect of repo has really fallen into disuse almost. The reality is that right now, or over most of the past 12, 13 years, it's really just been about lending money or borrowing money. Whereas before then, and now we're back into the early stages, I think, of real trading that actually involves repo, it was much more narrowly focused. And the main focus is, as it says at the start there, is to finance a long position. So I own a bond or a stock or something I want to repo, and I'm holding on to it. So it's fine. I own the asset and I own the economic interest of that asset, but really it's tied up. My cash is tied up in that instrument. So I might try to use it as collateral. And the obvious place to use it as collateral is in a repo trade. And I'll go to a counterparty and say, I have this asset. Can I borrow money against it? I may be doing that for my own firm, or if, for example, I'm a prime broker, I might have clients, and my clients have bought positions. And whether I'm doing this for their benefit or for my own benefit because I'm lending my client money, I may try to do a repo transaction into the market again to take cash that's been tied up into an instrument and for a short period of time borrow cash against that position. Okay. Now, the flip side to that, of course, is if I'm a cash lender, it's to collateralize a cash loan to finance my business. So in the first case, I might be a long position of it. In the second case, I've got cash. How am I going to lend that cash expeditiously and on a relatively low risk basis? So I want to make certain that if I'm going to lend my cash out, I don't want to just do an unsecured bank deposit because I've got quite a lot of exposure to my main bank anyway. I now want to lend money out to someone, but I'll take some collateral. And that's what I would do in a repo transaction. I'm going to lend my cash out, but I'm going to take securities as collateral. And so I'm going to reverse in those bonds and I'm going to sit on those as protection against counterparty default and a way to get my cash back. Now, central banks are very active users of it on a daily basis. And what they're doing is they are either putting money into the system, they want to introduce liquidity into the system, and on a short-term basis, right? So quantitative easing and all of those measures, look, those are longer-term measures, and they've turned out to be much longer-term, I think, than they expected it to be. But for short periods of time, a central bank might actually reverse in some bonds, so they put more cash into the system. Or if they think that there's too much cash washing around, they use repo as a short-term way of draining cash from the system. So they're just actually managing the money supply on a short-term basis. Now, commonly, and particularly in the post-CSDR, which we talked about last week, and I'll put a link to the video in, CSDR will bring in buy-in settlement fail penalties for banks that fail to deliver on time. And so what you can do is you can use a repo to get bonds in to make that delivery out. And of course, you can also borrow securities through securities loan transaction. So that's more sort of the operational efficiency side of things. You're actually getting bonds from where they might be sitting static to someone that actually needs them actively to reduce failed trades activity. And then finally, this is the area that I think has been not neglected, but there hasn't been as many opportunities over the last sort of 10 or 15 years. And that's yield enhancement. I actually have assets in the market. I have in my portfolio. I'm sitting there and I know there's a demand for those assets in the market. So something might be trading special. And what we mean by special is that particular asset is very much in demand in the market. I'm an owner of it. I can actually do a repo trade to get it out there and make a good return for making those securities eligible. So it's that rental value for the bonds that I own or the equities. Now, the other thing that you can do is you can lend out GC, you can lend out so your widely available high liquidity instruments where there's lots of supply. You just want to get cash in and you're taking a bond you have, getting low interest rate cash because it should be good quality assets that you're actually lending out, getting cash against that, and then actually taking either interest rate risk, maybe you're looking at a spread, or you might be taking credit risk. You might be saying, what I'll do is I will lend out my government bonds, get cash in, and then I'll do a repo on the other side, maybe, and I will actually do it for a lower quality instrument where I can charge a higher rate and I'll make a spread between what it's cost me to borrow the money and what the revenue is that I get for lending out. That's, of course, more challenging because it has impact across all of the financials from a bank, but clearly there's opportunities to do that. And then finally, there's also the opportunity there to finance less liquid or illiquid assets where you're saying, look, what I'm really doing here is I'm taking a risk on you, my counterparty, that you won't go out of business, and I will finance your less liquid asset, but I'm going to charge you for that. It might be a higher haircut. So I might be only lending you 90 cents on the dollar or 70 cents on the dollar or 50 or 20, whatever it is. You've got an asset you can't get any funding for. So whatever I'm offering you is theoretically better than no cash at all. And so I want a premium for taking on that additional risk. So that's one way that people actually generate extra income from their money. Now, those illiquid assets can have all kinds of features to them. They might have wrappers around them. They might have guarantees. So there's ways to mitigate the risk in that. And of course, every risk mitigation means that the return that someone would get for lending cash against that illiquid asset, the return you would get would be lower because you have less risk and it costs money to reduce that risk. So there's ways to do that. So there are ways to improve your returns through repo that extend beyond the simple short-term or overnight rates that you would get for lending or borrowing money. Okay. I'm going to turn now to some statistics from, first of all, the US and then from Europe. The stats on this page come from the SIFMA research report on US repo markets. It's their chart book 2022. So this is, I think it's based on data that was collated at the end of June 2021. So there's a few months lag in the data actually getting out. But I'll just go through this. Top left one shows that the average daily outstanding in trillion. Now this covers both reverse repo in the light green and regular repo in dark green. Now, you have to remember is the SIFMA searches the primary dealers. They're the respondents to the survey. And so this is from that respondent's perspective. How much are they doing as repo and how much are they doing as reverse repo? Because as I said before, repo and reverse repo are the two sides of the same transaction. So there is an other side to every one of these trades, which has the opposite definition. So just from the perspective of those dealers themselves, you can see that they're doing more repo than they're doing reverse repo, which means that they're more borrowing money than they are lending money. Okay, so but you can see it's stayed pretty much above 4 trillion with the exception of 2018, 4 trillion US dollars pretty consistently and not quite hitting 5 many years ago, floating in more of a narrower band since 2013. Now, I said before the overwhelming majority was very short term, and that overnight was the biggest. And as you can see here, in terms of this chart, this is overnight is dark green and term, which means this longer than overnight, is in the light green. So you can see it's always, the majority is always overnight activity where they're actually doing repo. Again, where they're borrowing money, they're borrowing it largely overnight. So this is 2.5 trillion US dollars out of a total activity, total book size of theirs of 4.3 trillion. All right, so that's just under 60% roughly. Now, so we've got big activity, lending and borrowing money. Majority of it's overnight, but almost all of it is short term. Now, what are they actually doing when they're repoing the asset? Again, when they have assets on their books that they're trying to finance, what are they financing? It's mostly U.S. Treasuries. That's what more than 2/3 of the activity is. And then mortgage-backed securities and the Treasury protected securities issued by the U.S. government. So again, high-quality instruments in terms of U.S. Treasuries and the TIPS. The mortgage-backed securities, clearly people are looking at that as a way to generate income. And then you have equities, corporates, whatever. Okay, so that's the type of asset, the majority of it extremely high quality. Now, where they are lending money against it, they're even more conservative, right? So the almost 80% is U.S. Treasuries, another 9.7%, almost 10% is in the Treasury protected U.S. government securities. So again, it's overwhelmingly, if I'm going to lend you my money, it's going to be good quality stuff. Okay, so you can see overwhelmingly good quality. So you can look at that. And then just to give you an idea, if I'm lending you $100, I want more than $100 of collateral from you to count for market variation, because even if it's an overnight loan, markets can move overnight and you might go out of business tomorrow, and I need a little bit of price protection there. And what you can see here from this chart on the right is for those people that trade in tri-party, this is typically what they're taking for collateral. Sorry, the extra margin that they're taking for the different collateral types. And so when we talk about agency, we're talking mortgage-backed securities, we're talking about U.S. government-related entities. All right. So 2% for those. Again, where they're doing collateralized mortgage obligations, again, slightly higher because these are all U.S. government directly or indirectly. And then you start getting into the higher margin securities, international securities, et cetera. And then you have the non-investment grade assets, which have the highest margin. But this is just typical. Of course, there'll be people that will have lower margins and people that will take higher margins. This just gives you an example. Okay. In Europe, interestingly, you can see that the total amount of repo and reverse repo activity that's being done is growing continuously since the start of this century, really going up. Again, very similarly, the interesting thing here, the reason I've included this chart is to show you how the trades get done. So you can see 56% get done bilaterally directly, another 8% in via tri-party, 8% via voice broking. So sometimes there are less liquid assets or people want to manage position size. So they might go to a voice broker who will try to arrange repos on their behalf. And so there's human intervention in that. And then this 27.5% is basically automated trading platforms. So you can see a quarter of the market. And look, that will almost, and that the majority of that activity will be overnight activity as well. If we look at the currency in Europe, typical currencies that are being used, you see the majority is obviously euro, and second is dollars, third is sterling. Over the past few years, dollars as a percentage has been slightly falling off. Sterling has been slightly picking up, and euro has stayed pretty much the same, but nothing really fundamental, but quite a range of securities, of currencies that the transactions are being done against. If you look again at the tri-party collateral that's used, you can see the pink section is government assets. And then this next segment here is public and subnational, so the state level financing. A much smaller percentage, really part of the overall book, is government related instruments. And then you have 11% of it being corporate debt, which is much higher than it is in the US, and the same with equities. And part of that is what banks carry on their books, where the financing is in terms of prime brokerage. So there's, again, a number of different factors there. And then again, here is the collateral analysis by country of issuer, right? So you can see it's a pretty broad spread there. The biggest individual country in this list, I think, is the UK, which is here. And then you get the broad range of other European and non-European names. So just some stats. Again, you can look at this at the ICMA European Repo Market Survey. That comes out every 6 months or so. Okay, who uses repo? Typically, people only talk about the first two. So there's the sellers. So these are the entities that are holding securities. That's dealers, investment banks, broker dealers, bond investors, traders, hedge funds. So these people have securities which they're trying to borrow money against for whatever reason. Then you have the buyers. So those are the investors that are cash investors. So these are the risk-averse entities that are trying to borrow money. And that includes, obviously, central banks, commercial banks, money market funds often have big chunks of money which they want to lay off on a very safe and conservative basis. Securities lenders are big repo users. Central counterparties have to do something with the cash that they get as collateral margins, and repo is a big component of what they do. Sovereign wealth funds have been growing in their involvement here. And of course, insurance companies, it's really part of their day-to-day flow of activity. Now, I've also added in this other group here, which are also buyers. So these people are less interested about borrowing cash per se. What they're trying to do is get specific securities, right? Because they need those for trading strategies. And so it might be market makers and hedge funds and securities firms. Again, very similar group to the first group, but these people aren't looking to finance. They're trying to get securities for part of their trading strategy. So although they still end up with the securities in their hands, it's to do something with those securities rather than to hold the securities as protection against a counterparty default. So they're trying to do something with those assets. Okay. That's it. The summary is, what is it? It's a short-term transaction between a cash lender and a securities holder. There might be many different reasons, from financing through to settlement efficiency, through to trading, through to getting leverage. There's lots of different reasons why people use it. The statistics are quite interesting. You can see the size and the scale of it. We're talking about trillions of dollars. Much larger than the securities lending market globally as well, which is an interesting point that people don't necessarily always understand, because it's a little bit more behind the scenes, professional to professional. There's no real retail involvement in this business. It's really financial market participants, really from any stripe, but also increasingly corporates have been getting involved. And there's many different reasons why corporates get involved and why banks want to trade with corporates. It helps with all of their statistics and ratios and figures. Always good. Listen, what I haven't put in here, which I meant to put in, was that we run a repo course as well, taught by Jeff Kidwell, who's an expert repo person from the US who's been involved in the business for many years. I'll put a link in the show notes to that course. It's a great course. Have a look at that if you want to learn more about repo. And as I said, next week, what we're going to do is look at repos in part 2, answer Kartik's example about doing or question about doing an example. I'll put up an example there. We'll dig into it a little bit more detail, more granular level. And then week 3, we will be doing the comparison of securities lending and repo. Fanny, always happy that you're here live. Appreciate you spending time with me here. So thanks for that. And yeah, I hope to see you next week. That's it. Have a great Saturday. Have a great weekend. Have a great week. And I look forward to catching you next time.